Hey everybody, welcome. I'm Tom Schmidt from Ticker Tape Investments, and we're here to run through the Ticker Tape presentation on tips and tricks for high income Americans. Obviously, there's a lot more of these than we have time to put in today's presentation. So stay tuned to tickertapeinvestments.com and our social media accounts, and you can get a lot more information. I will start with a standard disclaimer that this is not an offer to sell securities. Any investment that you participate in with Rita and me and Ticker Tape Investments will have a prospectus that you need to read with all sorts of information about the investment opportunity. Without further ado, I'm going to jump into it. So the impetus of this presentation and a lot of the content that we generate at Ticker Tape has to do with the fact that what you're told from financial advisors, from Wall Street, from CNBC, Fox Business, etc., is not the whole picture. And the conventional investment plan that these institutions promulgate fails those that have more wealth, more ability to take advantage of different investment strategies and tax losses. The problem is you're not educated about how to find those, that they exist, what you should be doing, what you shouldn't be doing. And so one of the things we've spent a lot of time on at Ticker Tape is researching these things, understanding the different options that are out there, why they matter to the average high income investor, and we'll run through them. I mean, there's a lot of things wrong with the traditional system, and I have to be careful because it's easy to just criticize the strategies and say they're wrong, but they're not exactly wrong. They're just not the whole picture. And it's like a tiny slice or an oversimplification, if you will, of concepts like diversification and correlation and things like this that make it palatable to the average American who's not educated in how to invest, and also in ways that make it easy for financial advisors and Wall Street banks to earn fees on people's money, to just collect them out of sweep them out of their accounts. And so those that have higher income, higher wealth should be investing in a whole different way, in a way that best protects and grows their wealth. So, a couple key points here. Number one is there's these cookie cutter solutions that are really designed for upper middle income earners, not high income, not ultra wealthy, not billionaires, but kind of your average American. And if you're not in that category, then you should not fall victim to those strategies. If you are in that category, the more you can learn about how to upgrade your strategy, the better you're going to do in the long run. We'll talk a lot about that today. Hidden strategies that you're not being told about, whether it's investment strategies or tax strategies. Oh my gosh, I can't get me started on all the things that the average American doesn't understand about the tax code and how you should be taking advantage of it. And then, of course, estate planning and legacy planning stuff as well. Remember, billionaires and ultra wealthy folks think in terms of decades, right? They're already thinking not only about their children, but their grandchildren and their great grandchildren, and what sort of investment strategies will benefit the family legacy over time. And so those of us who are not yet billionaires should go ahead and start making deploying those sort of strategies, thinking on that level in order to get the benefit of the stuff that the ultra wealthy folks sort of already know. Let's start with, in terms of tips and tricks, the number one tip or piece of information that most Americans do not realize is that private equity investments outperform the public markets. This is just about any time period you look at in history, this is going to be true. There's a bunch of reasons it's true, ranging from lack of volatility to this notion that by the time the company goes public, the money's already been made. Think about from the stage of startup to the stage that a company goes public, what is the increase in value of that company? Well, literally tens of millions at minimum. Nowadays, it's typically tens or hundreds of billions of dollars before the companies go public. So if you're only investing in the publicly traded stocks, you're missing out on all of that value creation. And so, there's a reason why billionaires invest as little as 10% of their assets in the stock market and in publicly traded bonds. Upwards of 90% of the ultra wealthy's assets are in private equity. And it's because of the lack of volatility, the better ability to diversify and be not correlated to the economy and to the stock market. And also this notion that the money's already been made once those companies go public. I've read articles from experts that say the only reason that billionaires and these university endowments put any money in the stock market is because they need a liquid investment, right? So if you put 10% of your total worth in the stock market, that gives you an opportunity if you want to take advantage of an investment or something or you need the cash, you can liquidate your stock market positions a lot faster than you can private equity. So I thought that was very interesting. And so, for me personally, for the Ticker Tape team, we are going to model after those people, those ultra wealthy billionaires, and put more of our capital in private markets, debt and equity, as well as other alternatives that aren't really equity, from gold and silver to oil and gas to real estate to cryptocurrencies and digital assets, all sorts of things that are not stocks and bonds. If you start thinking like that, it's going to be a lot easier and quicker for you to get further ahead. And this is just a very simple concept that it's easy to understand, maybe not as easy to implement. But if you talk to Ticker Tape Investments and groups like ours, you'll see lots of opportunities to invest outside of the stock market, start removing that volatility from your portfolio. And this slide is very important to us, that it's much more important for an investor like you to avoid volatility than it is to achieve a higher return. Huge concept here. If you've seen some of our other presentations, we have a slide that shows two sample portfolios. One is very volatile, the other is not, and they both have the exact same average annual return, 9% per year. The portfolio without the volatility does significantly better. And after 20 years, based on the assumptions we run, the person who has the less volatile portfolio the person who has the more volatile portfolio only has 69% of the amount of assets that the person with the low volatility portfolio does. And that's because if you have a 30% decline in 1 year because the market goes down a bunch, you have to have a much better than 30% return to make that back. And as the slide says, if it's a 50% drop, God forbid, you got to double your money just to get back to where you were. You know how hard it is to do that in an overall portfolio concept. I'd much rather be invested in private equity where I'm not going to have a 50% decline. There is no stock market volatility in a private equity or private debt portfolio. Very important. Wealthy investors who already have a significant net worth or who have a very high income and can continue adding cash to their portfolio prioritize protection over maximizing returns, right? So, of course, the younger you are, the lower your income, the lower your wealth, you may want to be taking more risk in earlier stage private deals as opposed to later stage deals and debt-related deals. Same sort of concepts you've been taught, just a little bit difference in where you actually invest the money. And then, of course, make sure you have all sorts of alternative assets. The name of the game here, very simple, diversification. I was taught originally diversified meant you had a large cap fund, a mid cap fund, and a small cap fund. Oh my goodness, that is not diversification. Guys, you got to have gold, you got to have silver, you got to have something else, platinum, copper, something like that. So it's not directly tied to the others. You got to have some oil and gas energy, uranium, different natural gas type investments. You got to have all sorts of real estate. By the way, a portion of your portfolio is in real estate. That portion by itself needs to be diversified, right? You need some residential real estate, be it multifamily or single family homes, apartment towers, that sort of thing. You also need some commercial real estate. You need other things like we're looking at RV parks, self-storage facilities, urgent care facilities with a real estate platform, etc. And get diversification even among your real estate investments, but make sure that you are taking advantage of reducing volatility, increasing diversification in private equity investments, private debt investments. The other thing is be smart about how you run your personal affairs, your financial affairs, right? Number one, if you haven't heard me say this before, reach out to Rita, get in touch with us. We'll get you the details. Hire your kids, hire your grandkids. Any kids in your family that are between the ages of 5 and 18 should be employed by your LLC. If you don't have a family business or some sort of LLC that's actually operating, create one. Get with Rita. We'll help you figure out how to do it free of charge. But get a business set up and start paying these kids to help. They can hang door hangers in the neighborhood. They can go through your emails and organize them. They can be your personal assistant. Give them some sort of job. Pay them up to $13,000 and change, whatever the limit, the tax limit is that you can pay them, that they pay no income tax. You get, your LLC gets the tax deduction for paying them, and in the process, you're teaching them about money and taxes and income and savings and all these sorts of things. It's a no-brainer. Another big one, if your income is high enough or your assets are high enough, you should definitely talk to us about setting up a trust and a foundation structure so that you can entirely eliminate your income tax. It can be as simple as a trust and a foundation. We'll give you the trust document, how to structure it, and then you can add as much complexity or as little as you want, depending upon your estate planning needs, your asset breakdowns, all those sort of things. But this is what, when Donald Trump says you're an idiot if you pay taxes, what he means is you should be taking advantage of the tax code's provisions that allow you to create a trust and do what the ultra rich do, right? They spend all the money they want to spend, and then they pay tax on the rest. Whereas the rest of us, our whole lives have been earning income, paying tax on that, and then trying to live on and spend what's left over. It's a much better strategy to actually follow what the tax code says and set up a trust and a foundation. Again, if you need more details, reach out to Rita. I'll put her contact info up at the end of the presentation. Another thing drives me nuts when I hear our investor partners talking about they have passive losses being rolled over on their tax return from year to year. Get on the phone with us. We'll get you with a CPA who can help explain how to get rid of those, take them in this year as a tax deduction, and avoid that from happening in the future. One of our friends, you know who you are when you see this video, was just telling me they're from New Orleans originally. They're looking at buying a home in New Orleans that they want to have as an Airbnb. The husband is a high-income attorney and has a lot of income that's coming in that he's paying tax on. And he mentioned that he could get some tax deductions on the operation of an Airbnb. And I said, oh my gosh, what you do is you manage it yourself, make it an active business for you, and then depreciate the house as a business asset, and you can almost eliminate your income tax for the next year by deducting the cost of the house against your active income, because it's an active business, not a passive loss. All kinds of strategies like that you can take advantage of. And then, of course, self-directed IRAs. No one should have an IRA at like Fidelity or Schwab or one of those. If you have those now, get with Rita. Let's get it moved to a self-directed IRA and a self-directed Roth IRA. You can have all those conversations about how to allocate between the two of them. But again, it's a no-brainer. Costs virtually nothing, and the benefits of being able to take advantage of non-public investments in those IRA accounts, especially a Roth, are incredible. So if you don't know about that, give us a ring and we'll be happy to talk to you about it. A slight twist on what we've just been talking about is asset protection. So first of all, you got to invest properly. Secondly, you want to make sure you're investing as much as you can by mitigating taxes, right? Make up a number. You earn $1 million, you're going to pay $400,000 to the government. You're going to live on some and then invest what, 100 grand a year. Why not eliminate that tax liability, have the full $1 million to live on and or invest? your wealth's going to grow that much faster, right? So step one, have the right investment portfolio. Step two, use all the best tax strategies to maximize the amount you can invest on a going forward basis. And then number three is protect what's left, right? Asset protection is very important. Trusts and foundations help with that. Setting up LLCs and holding companies can help with, number one, asset protection. Number two, sort of ease of use of accessing money and making investments, et cetera. And then again, what's very important to a lot of people is their legacy, right? How do you preserve something for future generations so they remember all this hard work you've done to earn this money in the short term? And so very important to take advantage of that third concept. Another sort of category in tips and tricks is how do you invest, right? How do you look at deals? How do you find deals? Ticker Tape, we spend a lot of time talking about these things, whether it's the 6 keys to successful investments presentation or the top 5 mistakes most investors make presentation, or any one of the other ones. What your financial advisor doesn't tell you. Lots of presentations on this topic. Things like make sure you're negotiating down the fees you're paying, make sure you're staggering investments to maintain flexibility and reduce liquidity risk, get some sort of structure that mitigates your risk, whether it's collateralized or a personal guarantee, or at a minimum, if you don't do those two things, make sure the guys you're investing in are up to their eyeballs in the deal so that they're very motivated to make it successful. Due diligence. Only secondarily important to diversification is make sure you're conducting due diligence on every deal you look at and vetting it to make sure it's right for you. Keys to this overall structure in a big picture standpoint: make sure you're vetting and structuring your portfolio correctly. Diversification and correlation. I didn't really talk as much about correlation yet as I should have. The notion that make sure you're not investing in private deals that are just strictly tied to the stock market, right? You want to get away from the stock market's ups and downs, right? So when the stock market goes down, you want the rest of your portfolio to go up, or when the rest of your portfolio has a bad year, you want to be having the stock market have a good year. So they're not correlated together. And you want to make sure it's not just 1, 2. It's not just this has this correlation and this is different. You want to have 7, 8, 9, right? You want to have some digital assets that aren't correlated to real estate or the stock market. You want to have some energy investments that are not tied to any of those. But also you got to watch not just the stock market, but also the economy, right? Invest in some things that if the economy were to go down, we had a bad recession, these asset types would go up. Things like mobile home parks, lower income apartment complexes. If you want to talk about publicly traded companies or businesses, things like the dollar store, car washes, right? Buy coin-operated car washes, the lower end of the economic spectrum. Those types of businesses tend to do better in a down economy. Don't be investing in Fendi purses and high-end assets if you're heavily correlated in the rest of your portfolio to the economy and the stock market. Number 3, reduce taxes. And number 4 is think in terms of building wealth. You're not just growing your portfolio, you're not just getting an investment return, you need to think in terms of building wealth, which involves all the above, right? The right structures for asset protection and growth, the right legacy estate planning components to make sure it doesn't get eaten up by estate taxes, or there's liquidity problems. One of my friends was telling me that he knows a person that has owned a piece of property forever. He's refinanced it multiple times, and now now that he's in his retirement age, he can't sell the property because he would have too large of a tax liability. So you want to make sure you're not falling into those kind of traps as well. Manage it, and from the concept of building wealth. Things you can do right now to start making a difference. Stop chasing hot stocks. Start making a long-term plan. Where do I want to be? Where am I trying to get to? Obviously, there's lots of stuff you can learn from the ticker tape presentations that are already out there. And we're here every Thursday doing one of these in the evening to teach you something new. But go out on the internet. ask ChatGPT, go search the internet, go watch other webinars, go on YouTube and watch videos to learn other things you can do to help build your wealth. Invest in your own future, right? Remember that once you've made a profit, you can't go broke taking a profit. You can go broke getting greedy, holding on to an investment too long, and all of a sudden it turns around and goes back down. So make sure you have a part of your analysis that is focused on keeping what you've already made. And then the other thing is, don't wait, start today. Doesn't matter if you're a billionaire or a millionaire or 100,000-aire, even little bits of money deployed properly will make a bigger impact on your future. And developing good habits now will benefit you as your income grows and you end up with more assets to invest. That's all we have for today. I really appreciate you guys tuning in, both the ones that are here live and those that I'm sure will watch this in the future. We'll see you on the next one. We're here every Thursday at 6 p.m. Central, 7 p.m. Eastern, 4 p.m. Pacific. That same link will register for next week's call as well. Keep an eye out and make sure you go to tickertapeinvestments.com. Check out our news and updates page with lots of articles and educational information. You also probably want to follow our YouTube channel to get some of the more in-depth content. Take care, everybody. Have a great night.